Welcome to The Explainer. I am so incredibly pumped to have you here today because we're diving into a fascinating 20-year simulation that completely turns everything we think we know about building wealth in the stock market upside down. We're going to dig into the numbers, trace the history, and uncover what I like to call the silent power of dividend compounding.
So think about this for a second. What if the real secret to building massive wealth wasn't finding the next hot tech stock before anyone else? What if it wasn't about perfectly timing the market or constantly checking your portfolio in an absolute panic? What if the secret was actually doing absolutely nothing? I know, it sounds totally counterintuitive, right? Maybe even a little crazy. We are so conditioned to believe that successful investing takes constant, grueling effort. But today, we're going to completely bust that myth.
All right, let's jump right into Section 1, the boring investment strategy.
We're going in a time machine back to the year 2006 to introduce the hero of our story. It's a highly disciplined, honestly kind of boring approach to wealth generation, and it all starts with this exact number, $100,000. In our scenario, an investor takes a lump sum of 100 grand and makes a single, one-time placement of this capital. And here is the absolutely critical rule for this entire simulation. They never add another dollar, not a single dime. They invest it once and then they walk away. No wild trades, no trying to predict the future, just a quiet, steady plan.
And this brilliantly illustrates our starting lineup. That $100,000 was split right down the middle. Well, into perfect quarters, actually. 25% each into 4 high-quality, dividend-focused ETFs, SCHD, DGRO, VIG, and DIVO. Now, each of these follows a slightly different dividend strategy, but when you put them together, they create a highly diversified, totally robust income machine. This portfolio is built entirely around quality companies that consistently reward their shareholders. But remember, the hardest part of this strategy wasn't picking these funds. The hardest part was what came next, doing literally nothing.
Moving right along to Section 2, surviving the 2008 crash.
Looking at our 20-year roadmap here, things actually started out fantastic in 2006. The portfolio grew pretty quickly to over $120,000. But then, bam, we hit 2008 and disaster strikes. The global financial crisis hit, markets absolutely collapsed, and panic spread everywhere. Our portfolio's value plummeted down to roughly $84,000. Just imagine that for a second. Imagine logging into your account and watching over $35,000 just vanish into thin air.
And guys, this right here is the ultimate investor dilemma. Your emotions are just screaming at you. The news headlines are all doom and gloom, and your gut instinct is telling you to panic, hit sell, and just stop the bleeding, which of course locks in your losses. But behind the scenes, compounding mathematics was working an entirely different, hidden reality. Because our investors stayed put, their automatically reinvested dividends were quietly scooping up more shares at massive, historically low discounts. They weren't actually losing, they were accumulating.
Which brings us to Section 3, the dividend snowball effect.
So fast forward to 2012. This is year 7 of our simulation, and the portfolio has recovered nicely to $140,000. And this is exactly where the kinetic energy really took over. Dividend growth and reinvestment started aggressively feeding off each other. The investor wasn't just earning dividends anymore. Those dividends were buying more shares. And then those newly bought shares started generating their own dividends, which bought even more shares. It's like a giant snowball rolling down a hill. The cycle just repeated infinitely, turning that initial lump sum into a self-propelling wealth machine, all without the investor lifting a single finger.
Next up is Section 4, COVID-tested investors again.
You know how it goes. History loves to repeat itself. By 2020, another massive stress test arrived. The markets crashed violently, and fear dominated the headlines once more. The portfolio briefly lost tens of thousands of dollars in value all over again. But the investors who panicked and sold, they entirely missed out on the massive boom that followed. Those who resisted the urge to sell, the ones who just stayed seated, saw a full recovery by the end of the year and just kept right on climbing. This strategy didn't reward high intelligence or perfect market timing. It rewarded pure, unadulterated discipline.
Okay, you're going to love Section 5, the $200,000 checkbox. This brings us to what I think is the most shocking discovery of this entire 20-year simulation. The secret sauce wasn't about which specific ETF the investor chose. It actually came down to a single, completely mundane setting inside a standard brokerage account that changes absolutely everything. Let's say our investor had simply taken their dividends as cash payouts over those 2 decades. You know, collecting the income but not reinvesting it. Their original 100 grand would have grown to roughly $590,000. Honestly, That is a very respectable number. Not bad at all, right?
But no way you have to compare it to this. $780,000. That is nearly $200,000 of extra additional wealth generated by doing literally just one thing, turning on automatic dividend reinvestment, or DRIP. It is the exact same portfolio, the exact same market, the exact same amount of patience, but it yields an entirely different result, purely because they checked one little box. Mind-blowing.
Let's break down the grand totals in Section 6, the final score.
Let's rapid fire through these final, honestly staggering metrics. Starting capital, $100,000. Additional contributions, 0. Trades made over 20 years, 0. Ending value by 2025, approximately $780,000. But here's the absolute best part. The annual income is now sitting at around $24,000 a year. That means the portfolio is currently generating almost a quarter of the entire original investment amount every single year in pure dividend cash. That is just phenomenal for a strategy so simple you could write it on a napkin.
Let's wrap things up with Section 7, the real lesson.
The deepest takeaway here isn't about perfectly picking specific funds. The biggest challenge in investing isn't choosing the investments, it's controlling your own emotions. Look, it is incredibly hard to watch the markets crash. It genuinely hurts to see your portfolio drop by 35 grand. But the investors who win the game aren't always the smartest stock pickers on Wall Street. They're simply the ones who refuse to panic when everyone else is losing their minds. Compounding works mathematically, but selling, that's strictly emotional. And over a long enough timeline, acting on those emotions is far more expensive than any temporary market downturn. As the old saying perfectly puts it, time in the market often matters far more than timing the market. Sure, past performance never guarantees future results, but the mechanics of compounding only work their magic if you give them enough uninterrupted time. The folks who stayed patient through the crashes, the scary recessions, and all that deep uncertainty, they were the only ones who allowed time to step up and do the heavy lifting for them.
So, here it is, the surprisingly simple 4-step strategy that outperformed all the panic and all the active day trading. Step 1, buy quality assets. Step 2, reinvest those dividends. Step 3, stay absolutely ruthlessly patient. And Step 4, repeat. That's the whole shebang. Start small, stay amazingly consistent, and just let the math work for you.
So, I leave you with this. Are you ready to let compounding do the heavy lifting and turn time into your absolute greatest financial asset? Take a serious look at your own portfolios today, go check those dividend reinvestment settings, and really ask yourself if you are truly allowing the silent power of compounding to work its magic for you. Thank you so much for joining me on this explainer. Keep learning, stay patient, and I will see you next time.